Wall Street CEOs are preparing to do a mass layoff that's going to leave millions of Americans unemployed. And in fact, this mass layoff has already started. Companies like Goldman Sachs, Microsoft, Intel, Walmart, Peloton, and soon to be Twitter are laying off thousands of workers already. And these layoffs have everything to do with a trend that I call the hire fire cycle in the US economy, where during economic boom times, Wall Street corporations and CEOs typically overhire workers, and they double and sometimes even triple the amount of workers that they have. A great example of this is Twitter. Back in 2017, Twitter employed only 3,300 workers. Fast forward to 2021, that's more than doubled to over 7,500 workers. Well, clearly Twitter hired more workers because they're earning more income, right? Wrong. Twitter's income has actually dropped precipitously in that span, going from a $400 million profit in 2018 all the way down to a $400 million loss in 2021, which is why Elon Musk is now planning to cut 75% of the Twitter workforce. Because Twitter and many other corporations in America are now having to enter the fire stage of the hire fire cycle, where they have too many workers, they're losing money, and a recession is here. So the only option for these companies is to lay off workers. And in particular, the workers most impacted by these layoffs are going to be white collar workers, highly educated workers with high incomes. And the reason is simple. During the pandemic, white collar workers never really experienced a major recession. High income educated workers got the benefit of working from home in their professions. The result is the number of professional services workers in America has surged all the way up to 22.5 million at the end of 2022. These are tech workers, accountants, lawyers, marketing specialists. I think as many as 4 million of these professional service workers in America could be laid off over the next several years. And the unemployment rate in America, which is now 3.5% at a record low, I'm predicting it could be as high as 10% 2 years from now, similar to the levels experienced in the 2008 financial crash, similar to the levels experienced in the double dip recession in the early 80s. The unemployment rate hit 10% in both of those recessions. I think something similar could be coming here, which is of course going to have a big negative impact on the US economy. In particular, will cause asset prices to crash further. I know a lot of you out there are wondering, when is the bottom for the stock market and the housing market? When is the time to buy? And I'm here to tell you, the bottom is not going to come for stocks and housing until we see a big surge in the unemployment rate. That's when you're going to know. After the unemployment rate goes to 5, 6, 7, 8%, that's when you're going to know that stock prices and home prices have gone down enough to justify buying, particularly in certain cities, everyone. I got a lot of people who watch this channel who are interested in the housing market, and now I'm going to give you some data on the cities that are going to get hit hardest by these Wall Street CEO corporate layoffs. And the metric I'm looking at to tell me the cities that are going to get hit hardest is the number of people, the share of people that work from home. Because we have a very interesting trend actually developing in the housing market right now, where the more a city or a metro has people working from home, the more that home prices have gone down over the last 5 months in the beginning of this housing crash, which is a very interesting relationship on this graph, everyone. Now, you would think it would be the opposite, right? The more people that work from home, that should be better for a local housing market because it means people have a bigger demand for space. They want a bigger home office, so they want a bigger house. But no, we're seeing the exact opposite. Heavy work from home markets like Boulder, Austin, Raleigh, San Jose, San Francisco, where over 1/3 of the workers in these metros worked from home in 2021, they have the biggest drop in home prices. And the reason they do, in my opinion, is because we are seeing the layoffs hit these cities first. These work from home, tech-centric markets. We talked about Boulder, San Jose, and Raleigh a bit earlier. DC is another market with a lot of work from home exposure. So is Charlotte, so is Seattle, so is Durham, North Carolina, Ann Arbor, Michigan, Atlanta, Georgia, Portland, Oregon, Trenton, New Jersey, Minneapolis, Denver, Colorado. Now, there's two reasons why these work from home cities are most exposed to the economic destruction that's coming in this recession. The first is a remote worker is much easier to lay off and fire than an in-person worker. The human connection isn't there. Studies show that bosses often forget about their remote work subordinates, so it makes sense that a city with a lot of remote workers would have more layoffs. But the second reason, perhaps even more important, is that remote work markets are heavily tied to the technology sector. And it's the technology sector in America where we're primarily seeing these layoffs and where we're going to continue to see these layoffs. And what's wild is actually how ruthless some of these tech companies, especially the tech company CEOs, are. I know someone who just got laid off in one of these cities we just talked about, and they basically fired him and his team 1 month after promoting him. And so what you gotta also understand is a lot of these technology companies have no clue what they're doing. They don't have a business plan. They simply reacted to the boom during the pandemic. Now their revenues are dropping. Now they're losing money and they don't know what to do. So they're just firing workers left and right. And as we go along in this video, I'm gonna talk more about these cities that are most exposed to the layoffs in the housing crash, because it's very important for you as a home buyer or real estate investor to understand the economic exposure that your city has to a downturn, whether it's going to impact your home values if you're a homeowner, or whether you have a job in one of these cities that's going to be exposed to these layoffs. You know, a basic rule of thumb that I've developed, for people to understand your risk of being laid off is two main things. Ask these questions. Number one, does my company earn a profit? That is very important to know. Everyone should know the answer to that question about their company. If your company does earn a profit and earns a healthy profit, you're likely going to be more insulated to this recession. There won't be as many layoffs at companies that make money. What are some companies here that could fit the bill at being at risk of big layoffs? Well, MarketWatch just came out with an article about 15 money-losing companies that could become the stock market's biggest unicorn failure ever. This list includes Uber, WeWork, Rivian, Snapchat, Lyft, Airbnb, Palantir Technologies, DoorDash, Robinhood, and Wayfair. These are companies that have cumulative losses of over $3 billion since they went public. The other thing that you need to watch out for with your company engaging layoff risk is if it has a lot of debt. Companies with a lot of debt are really in the crosshairs here of these Wall Street layoffs, particularly ones that are going to have to refinance that debt over the next 1 to 2 years at significantly higher interest rates, right? Like the Fed has jacked up interest rates over the last year. Long-term bond yields are now much higher, which means any debt-ridden company is going to have big issues when they go to refinance. Like think about like a homeowner on an adjustable rate mortgage. All of a sudden your costs go way up. It's going to be bad news. There's going to be a lot of layoffs, I think, with debt-ridden companies. But everyone, I got to give you all some good news at this point of the video. My proclamation for the US economy in these layoffs isn't all bad. I think there's certain industries actually that are going to do pretty well, that are going to weather the storm in the US economy over the next 1 to 2 years. In particular, I think one of these industries is manufacturing. You can see manufacturing has actually lost a lot of employment over the last 20 years, especially compared to the professional services jobs we looked at before, and that was due to outsourcing of manufacturing. But there seems to be a trend now towards onshoring of jobs due to global supply chain disruptions during the pandemic. A lot of companies now want to produce more of their goods and materials here in America. So that should be good for manufacturing employment in the long run. So I don't think we're going to see manufacturing jobs get hit as hard as, say, white-collar jobs in this recession. In addition, I think we're going to see leisure and hospitality workers who work at restaurants and hotels. I think we're going to see them weather the storm better as well, because leisure and hospitality employment in America is still 1 million roughly below what it was before the pandemic started. So there's actually a very legitimate shortage of labor in these industries. I'm sure if you guys go to any restaurant, you're likely going to see a help wanted sign on that restaurant right now. And there's simply not enough workers for those positions. So even in a recession, I think those type of more blue collar jobs like leisure and hospitality and manufacturing are going to perform better, which means certain cities are also going to perform better in terms of their economies and their housing markets. If we go back to this scatter plot comparing work from home markets to how home prices have changed, let's look at the complete other side of this graph now. The markets with the lowest work from home share, where home values have continued to go up over the last 5 months. What do we see? Market like Knoxville, Tennessee, Little Rock, Arkansas, Tulsa, Oklahoma, Savannah, Georgia, McAllen, Texas. These cities are going to perform much better in this recession because they have workers who actually need to be employed in these cities. They actually go into real jobs where they do real things for companies that tend to make more money. If we look at this map, the middle of America has a much lower share of money-losing publicly traded companies than the areas on the coast. And that's why I believe the middle of America, Midwest, and Deep South is going to perform much better in this recession going forward. There's going to be fewer job losses, and home values aren't going to go down by as much. Now, one final word here on Elon Musk, everyone, and his plans to fire 75% of the workers at Twitter if he takes over the company. A lot of people are outraged at this right now. I see a lot of mainstream news articles saying Elon Musk is mean and he's a sociopath. How could he do this? But folks, Twitter loses money. It lost $411 million before taxes in 2021. At some point, you need to make money as a company in America. And this is something that, people have forgotten over the last couple years with all the free stimulus, all the low interest rates. This idea of making a profit wasn't a thing. Well, now it's a thing again in this recession. So I give Elon Musk actually credit for suggesting what needs to be done with Twitter. Maybe it's not going to be 75% layoffs. We'll see what ends up happening there. But I think it's a model that a lot of other tech companies and money-losing companies are going to follow. These layoffs are going to be very severe in white-collar industries, and they're going to negatively impact the cities and the housing markets associated with them. Lastly, everyone, make sure to leave a comment below and let me know what you think about this white-collar recession that I'm predicting. Particularly, what are you seeing out there with your career? Are you seeing these layoffs? Are you not seeing these layoffs? You guys are my eyes and ears on the ground of the U.S. economy, so let me know below.